Welcome to this Killik Explains Finance video. This week, why ethical investing is harder than you might think. Now, the numbers, it's certainly popular. So in 2016, according to Boston Consulting Group, assets under management following some kind of ethical mandate, and it does come with a number of titles, this particular approach, hit 23 trillion US dollars. Pretty sizable number, and significantly that's up from 18 trillion in 2014. So not only is there a large pool of money out there following some kind of ethical mandate, but it would seem to be growing and at a reasonable rate. On top of that, 82% of high net worth millennials are interested in SRI approaches, that's socially responsible investing approaches, i.e. ethical, versus 45% of all high net worth investors. So amongst younger generations, this is certainly proving popular. So what is it, and why is it harder to achieve than perhaps you might think? First of all, what are we talking about here? Well, basically, ESG is the current way, it's described as the current popular acronym, and that is essentially an investment strategy based around picking stocks or following funds which are driven by environmental, social, and governance concerns. In other words, low environmental impact, high social conscience, and high quality corporate governance, if you like. And the approaches can be many and varied. So you can either pick individual stocks, let's say, more about this in a moment, which follow the criteria you're looking at, or you can simply take a broad basket of stocks and start to exclude companies that don't meet your mandate. So, sounds straightforward enough and it sounds sensible enough, but there are some problems. And you'll start to hit them quite quickly. First one, the most obvious one, is what actually do you mean by ethical investing? And you'll see that actually what you mean and what I mean may mean two completely different things in investing terms. Secondly, once you know what you mean, is there a product out there that meets your needs? How are you going to actually put together this portfolio which is SRI, ESG or ethically based? And thirdly, do you understand the implications for your broader portfolio and potentially its performance? Now, ESG or all three is what I've called problem number one there. So what is an ESG portfolio? Now, it sounds simple enough. I want to invest on an ethical basis. But actually, on the right-hand side here are some of the criteria, just some of the criteria which could be used to screen stocks to go in one of these portfolios. So are you talking, as many people are at the moment, about low carbon, non-fossil fuel stocks? That's a popular one. Or are you avoiding vice stocks, as they're known? More about that in a moment. Or are you looking for non-military stocks, so maybe screening out defence companies, for example? Or is it religious values you want your portfolio to follow? So those could be Christian, Catholic, Islamic, and so on. Or is it you've got an interest in health stocks, and therefore you want to screen out alcohol, cigarettes, and unhealthy foods? Or maybe, popular certainly a few years ago, are you looking for non-GM type stocks? Or maybe it's renewables, recyclables, you get the idea, the list goes on. Or perhaps you're looking for something more holistic, so only including firms that are sympathetic, empathetic to the local economy, to suppliers and or employees, and so on. So once you start thinking about it, you've got to think quite carefully about what do I mean by ethical investing. And if you're buying a fund off the shelf, is what you mean what they mean, and so on. So, next thing, passive or active. So let's say you think, right, well, basically, I'm not going to build my own portfolio of ethical stocks. Reasons coming up, I'm going to buy a fund. Well, what are the pros and cons there? There are quite a few funds out there, exchange-traded funds, for example, which claim to follow some kind of ESG, ethical, or socially responsible investing approach. So that's good. They're cheap, or cheaper anyway, ETFs tend to be, but you need to be careful. So without naming names, you look under the bonnet carefully at one of the bigger S&P 500 ESG indices, all right, which excludes, or claims to exclude, fossil fuel businesses. It's quite a popular one at the moment. If you look carefully at some of the companies in that index, you'll find that actually it gets a bit grey around the kind of utility firms that are included and some of the banks which indirectly finance energy firms. So you've got to really look quite carefully in order to uncover a portfolio within an index which is purely ESG driven. Active funds, you could take another approach. If you've got a big enough portfolio, this usually is only people with big enough portfolios, you could, if you're one of those high net worth investors, put together your own portfolio following your own mandate and criteria. That's always true if you build a portfolio. So an investment manager could help you put together something which takes account of your ESG objectives, whether your money is going into funds or stocks or a mixture of the two. There are active funds out there that specialise in following ESG mandates, but inevitably you will pay a bit more usually to follow one of those two approaches or a combination than the pure passive approach on the left. But you might end up with something that you're more comfortable with at the end of it. Then there's performance. Now there is some good news and some bad news here. So to be fair, some ESG indices, like the FTSE4Good UK index, for example, have returned around the same over the last 5 years as the broader FTSE 100. So that's not bad, and that's focusing on firms that meet globally recognised corporate responsibility standards. Over in the US, the KLD 400 ethical index, which is pretty well known, has returned around 109% over the last 5 years, total return basis, by focusing on a broad spread of ESG firms, if you like, versus 108 the S&P 500 over the same period. So it's not always fair to say that ethical investors pay a penalty in performance terms. But it is true to say that vice can pay, if I can put it that way. So unethical sectors have tended to be the ones that have performed historically pretty strongly. All right. So if you're looking at pure investment returns, stocks in the alcohol, tobacco, gambling, gaming and defence sectors have not only offered pretty substantial total returns, but actually for income investors, they're often some of the places that they'll go looking. And interesting food for thought here, Norway's sovereign wealth fund, which is huge, had a go at excluding vice stocks completely as it screened for them over a period of 12 years from 2004, and they reckon their annual returns suffered by around 1.6%. Now, some people would say, well, so what? I'm prepared to pay that price, but just be aware that there might be a price to pay. And then you've got to be a little bit careful to make sure that you're picking up an index with an ESG focus, all right, which is not the same as the broad index, or building a portfolio which is not the same as the broad index. Watch out for tracking error, under diversification, where you bunch inadvertently sometimes into too narrow a selection of sectors, and whether you're paying for something the market delivers for free anyway. So the market, for example, recently the stock market has punished stocks in the US which are linked to firearms, so names like Walmart, Kroger and Camping World, and meanwhile Remington's gone bankrupt. So in other words, as an ESG investor looking for non-firearms based firms, you may be putting effort in that the market's already kind of delivered in one way, shape or form. Now, to conclude, so I'm going to suggest, yes, go for it by all means if you think ESG investing is for you and you can find the right vehicle through which to do it. But here's an alternative. So, go green, as I've called it. The choice of ESG funds and investing options is growing. There are both passive and active styles of funds out there that try to achieve some kind of ethical mandate. All right, returns can be certainly reasonable, can be comparable to broader funds, let's say, as long as you're comfortable with the composition and as long as you're comfortable with the mandate matching your version or your definition of what ethical investing is all about. But some people would say, why don't you keep investing simple and then achieve your ethical ambitions elsewhere? So an alternative approach would be just to recognise that it's going to be very difficult to put together the perfect ethical portfolio given some of the constraints and limitations I've just mentioned. So focus on designing an investment portfolio which will achieve your investment goals, whatever those are, at a tolerable level of risk for you, and then by all means fund things you are passionate about separately from the returns that you generate. Okay, to email me on any of the topics I just mentioned, editor@killik.com. If you'd like to watch videos related to this one, killik.com/learn.